1st February 2023, Wednesday, MAO with Cal. Guys, Jim Cramer better watch his back because the MS Bears are watching him right now. Now, who are MS Bears? Of course, the Morgan Stanleys. Now, of course, it's not directly they're watching him, but because Morgan Stanley have been calling for sell and Jim Rogers calling for buy, so I kind of like in think that way, right? Okay, but nonetheless, this is a must-watch video because there's so much technical information to share with you. So don't miss it, guys. This is very important. Let's go. Now, once again, guys, please make sure you do your risk assessment. Tonight is the FOMC meeting, so do expect the market to be very volatile from the moment the result comes out and during the journalist meeting. All right, and of course, thank you, Ames, for the kind sponsorship. So let's recap what happened last night once again. Wow, the Dow Jones recovered 369 points. My goodness. The Nasdaq up by 190, and of course the S&P up by 59, and of course this is incredible, and you can see Microsoft, Google, Apple, Amazon all went up, and even our Tesla is up by 3.94%, which is back to 173, the same number that I mentioned to take profit just 2 days ago. So what is happening right now? Let's take a look. So the thing is this, it was because that General Motors came out better earnings, okay, and ExxonMobil obviously solid earnings. So these two brought the market much higher. And of course, the employment cost index, all right, is a very important measurement for the wages. All right, also show that the compensation increased by 1% and it's below 1.1 estimated by the boys. So it's like, okay, 1.1 was the expectation and it came out 1%. So it's slightly lower and they are happy with that. Now, the next thing is that the market is widely expecting a 0.25% rate hike today. So I'm going to be upfront with you, right? I know everyone around me in the market is 25 basis point, all calling for that. I'm just going to stand at 50. I know that I'm basically against the whole trend here. It's not because they are trying to be funny, but I think that if Federal Reserve do 50, it will be an easier and faster way to solve the inflation issues. But if they decide to go to 25, and most likely they'll say there'll be another 25s coming in. So again, there'll be initial knee-jerk happiness, rally, because it's 25, but then again, if the Federal Reserve maintain that there will be more hikes coming in to maintain or reduce inflation, then of course, then there will be a problem. All right, so that is something that I feel. Okay, anyway, but the thing is this, undeniable, it's a stellar start for 2023. January itself, the S&P 500 up by 6.2% and the Dow Jones up by 2.8% and Nasdaq up by 10.7% for the month of January. So based on the traders LMAC, we all know that if January is a good month, then of course likelihood the market will be positive by the end of the year. Now last year we had a very bad January, so probably that explains why the market was down. Now for me itself, right, I kind of think this way, okay. I still think that the market need a pullback, okay? So now we have a very strong January month, okay? This is January month, it's very strong, right? I still think that if the market pulls back down, maybe to April time, example, and then that will be a very good time to buy a lot and then hope that it will go up all the way until December. I think that will be a pretty good strategy if you think about it. So take note of that, okay? Now, we all know that now everyone is very positive because the stock market just relentlessly not able to go down. Because if you look at the chart right now, the stock market actually went down first in the morning to afternoon period during the US time, and then you can see the market boys came in pretty strongly after the market triggered the low of the day with the closing at the low, and then next moment, next 5-minute chart, the buying just come out and then relentlessly pushing up and breaks. And look at the last 30 minutes. My God, this is very clear. This is ultimate pushing. So it seems that everybody is expecting the Federal Reserve to give a 25 basis point and they think that that's good. So that's why Wall Street is pushing Federal Reserve to go slow with their interest rate hiking. Now, Jim Cramer obviously is very bullish. Now, I have lost track how the hell he is on CNBC. One moment buy, one moment sell, one moment buy, one moment sell. Now, this guy is always flipping around. But if you look at it, his statistics, whenever he call for buy, I think a lot of traders will be watching him very closely. All right. So anyway, now Jim Cramer is saying that the market is in a bull mode right now. It's time to buy on dip. Okay. So let's hear him out and see why. In fact, he's saying that now, even if the market doesn't reverse today, it will be always tomorrow. And he thinks that, right, the market is bullish. Don't bet against it. Okay. Don't bet against him. So let's watch Jim Cramer and what he has to say with regards of the market right now. Let's take a look here. Let me just get Jim Cramer into the picture. Let's go, Cramer.
bull market. And I think we are. You have to prepare yourself. Not for days like today where the Dow gained 369 points, S&P jumped 1.46%, and the Nasdaq pulled over 1.67%.
House of pleasure.
But for days like yesterday,
House of pain.
when the averages look like they're rolling over, the bears are screaming about the sky falling, and everybody's bracing themselves for a real roundhouse. We have to prepare for the down days now because in a bull market, they're buying opportunities. They're how you get a better price on the merch, or merchandise, as they say on the trading desk. Problem is, it's hard to think that way when the market looks ugly. We're used to buying the dips and so-called selling the rips, and those days may very well be over, replaced by actual investing. We were in a bear market for roughly a year. And before that, we had a market that was somewhat pernicious too. It was dominated by a handful of mega cap tech names, and that was for ages. Narrow, unwieldy, and in many ways dangerous for most of the S&P 500. The mega caps carried everything on their back like giant steam trunks filled with stocks. So I think many of us have forgotten what a real bull market looks like, or they never seen it at all. You know what it looks like? It looks like today. When we see the signs of a real bull, you need to change your approach to down days like yesterday. In a bull market, they're just like the days when Jimmy Chill is in his garden deadheading, clipping the dying branches of stems, making sure there's sustenance for the real plants. Yep, yesterday was a pruning day, which meant it was the perfect time to buy the high-quality stocks that were put on sale by Wall Street's hedge trimmers. And why not? They'll grow faster, stronger, and better, just like my plants.
Don't miss a second of...
Now, I cannot deny that Jim Cramer is right. Because why? The market has been relentless, okay? Every time the market comes down, the market push up, comes down, push up. So if you ask me, right, it is a bull market, right? It's a bull market within a bear market. So it's going to be very confusing here. So let's see the charts right now. But before that itself, right, one thing to note, there will be a lot of earnings this week, all right? About 20% of S&P 500 stocks will be coming on the earnings. And if you ask me, gradually, if you look through the screen, the whole entire, the list, I just feel that most of them are not going to perform well. Really, most of them are retail stocks, and I don't think they can come out any better. That's my view, all right? So let's hear what Morgan Stanley have to say, not Mike Wilson yet. All right, Brian Winston says about the positioning of theirs on the FOMC meeting. All right, this is interesting because if you look at it right now, right, they are kind of saying that the case for recession is getting stronger, and the thing is that the economy is poised to slow down more than expected. All right, this is from Morgan Stanley. So I have the video here. Let's listen to them and see what they have to say. Okay, let's go. Oh, okay, I don't have the video. Apology on that. So they are actually saying that they are looking at the recession to be coming in. All right. Then of course Mike Wilson came in later. So they are saying that, right, it will be likelihood that the Federal Reserve will push back the easing of financial condition because they know that the earnings are not doing well, and the barbell of the peak curve safe assets like 10-year. The minus the emerging market itself, it seems that it's a better deal. So in fact, Mike Wilson later will tell you that he's actually looking to get people to buy the bonds instead. This is something very, very interesting. Okay, so this is Mike Wilson, and apparently he says that the bear market is at the final leg, and because the weak earnings season is coming in, which I totally agree with him, and therefore the market looks frothy, and it's time to be very careful. So let's hear what Mike Wilson has to say on the screen right now. Let's go, Mike Wilson.
The market is looking frothy once again. Mike Wilson is Morgan Stanley's chief U.S. equity strategist and CIO, and he's here with us in Miami. Mike, it's great to see you here in person.
Yep, thanks for having me.
In the sunshine.
It's nice.
The Fed has no reason to even give an olive branch to the bulls at this point, does it? There's no gain from that.
I don't think so. I mean, they've done a lot of hard work. They've done the hard work, right? They've got rates to 4.5%. Like, why quit now? Particularly with the froth now coming back. As you said, the financial conditions are actually where they were a year ago almost when they started raising rates. So there's no incentive for them to do it. But I have no idea what they're going to do. The way I look at it is this is an event that's been, thought about now for 4 months. This is part of our call in October that the Fed may pause after this meeting. So we've had the rally at this point, right? And to me, it's simply the market needs to get past this event, and then we can price the fundamentals again, which are deteriorating.
Financial conditions are as loose as they've been. You just said that. There's a truth to that, but yet the market doesn't seem to acknowledge it. So one would think, given what the Fed has done for the last 14 months, financial conditions be as tight as they've been in a decade. They're not. Speak to that, and what is the market not seeing?
Well, I think the market did adjust to that last year. We saw a major adjustment in multiples and the bond market, of course, because the Fed did tighten financial conditions. But now the market is looking past it as if all the fundamental news can be overlooked. And the fundamental news is deteriorating significantly. We're seeing that earnings tonight. You guys were just discussing that. We think it's going to continue to be the case. And once again, once this event gets past us and people realize the Fed's not cutting rates, there's no more, heroin, so to speak, then we're going to price the fundamentals, which are clearly deteriorating in our view.
Alright, so you heard him very clearly, and I love the way he analyzes. Now he's saying that, okay, in October they already mentioned that there could be a chance that the Federal Reserve may pause rate hiking by this meeting, which is February, which I totally agree. The thing is this, alright, he says that once the Federal Reserve stopped saying that they will do anything else, that means that after they pause it or reduce it, they don't say about anything rate cut, the market will panic, because that means that the interest rate, it will still be going at 5%, 4.5 to 5%, and that will be the ever cost for the business. And if the earnings are already coming down because of the increasing interest rate, so think about this, if the rate just maintain for 5-6 months, that will hurt the whole earnings once again. So that's the reason why I feel that he's absolutely correct. So well, Jim Cramer is saying that, well, the earnings are bad, but the price is going up, so it's a bull market. Now, he's not wrong, but if you look at in the long haul, that once the cost retained still the same, while earnings are to reduce and demand reduces, think about this, that is whereby the earnings will really hit. And that's why I feel that some of the bigger boys like the United Health Group, their earnings are coming down right now. And they are one of the epicenter stocks to watch out for. And if they are not performing well, it's almost clear the rest wouldn't be doing that well. So with all this information, right, let's look at the S&P chart right now. Now the S&P chart, very clearly now, we are actually going up. Okay, I repeat, we are actually going up, because look at it now. Again, this is A, and this is B, and this is C, and this is D, and this is E, obviously. Now we have a very clear breakout at E, because the market came back down and rejected. Now this is a very bullish signal, undeniable, very bullish. And then now the price, look at it. Yesterday the market, the day before, sorry, the market closed down, right? Then the next day, which is yesterday, the market actually closed up. So it basically engulfed the entire rate bar of the day before. So this is actually bullish. And of course, the volume itself has increased. And so that is meaning that the buying is absolutely real. That means that the boys are coming in. So with all this content right now, undeniable, we have a very strong base setting at 3809. And that is, again, a strong stand of the bull. So, of course, you may say, Kel, wait a minute, are you flipping your view right now? No, I'm not flipping my view, because I'm informing you that the boys are basically pushing relentlessly because they expect the Federal Reserve to basically cut interest rates. But if the market doesn't cut, and the market realizes that this heroin, which Mike Wilson just mentioned, is no longer there, then the selling will be torrid. Okay, that is my view right now. So we cannot deny this. 4,100 is a very interesting double top back then in December. So if this will continue, we saw something similar back in January. So will we see that again? So if the market have a quadruple 4100 resistance, I think that if I'm a trader, I think shorting there itself can be pretty good. But of course, if you think that the market will go higher, then the next number the market should be hitting will be 4,200. Now do note, Mike Wilson says that 3,009 was a good level to short, and he's now very, very wrong. So of course, undeniable, somebody asked me, Kel, last year he was spot on and no one believed in him, and now this year everybody believes in him. Is it because now the boys put him on the table and then let people be hoodwinked by him? Well, I would say that if you actually listen to him carefully, I don't think he's doing that. But again, I can be wrong. So all I can say is, guys, watch out for all these numbers. It may be very important. This is something that you must take note and be very pretty objective with this, yeah? So guys, if you think that the market is going to be bullish, then 4,100 will be the first resistance, then 4,200 will be the next target, okay? But if you're bearish, then look out to sell at 4,100, and the first support will be 3809, alright? Okay, so why am I not comfortable? Thing is this, Eurozone came out with a surprise expansion in the fourth quarter, and that curbs the recession fear. But wait a minute, we all know that the fourth quarter itself is good because there was so much funds coming in. Alright, and inflation is definitely coming down, so definitely to have a surprise expansion is not something that we don't expect. But the thing is, you look at Germany right now, the economy has unexpectedly shrunk by in the fourth quarter, and that is meaning that recession is on the card. And of course, if you look at it right now, there are more, what they call even like this, Portugal is showing inflation is creeping up. This is not good. Now, some alternate market data for you right now. Now, this is the S&P 500 hedges positioning. So we can see that whenever the hedges are fully in the market will have two positions. That means that the market will come down first and then it will bottom out pretty soon. All right. That means that if a lot of people think the market will crash, usually the market may come down first initially, then it will bottom out. This is what I'm trying to say. And if you look at it right now, right, the current situation now, the position size is pretty heavy. So let's take a look in the past, right? When the position size is pretty heavy, we do see the market pulling back, okay, significantly. And then after that, the market will form a base and goes up. So if we do not see the selling at the moment, right, are we telling ourselves that the market is now too concerned? If it's too concerned and if the market is not going to go down and the market continue to go up, would these people come back to basically close their position and push the market higher? Well, it's all possible. And of course, the OEX open interest ratio, you can see right now, wow, with a very, very low level. The last time we saw something like this was back in 2019, and that was where the market hit a low, stop there, and then we have a very strong rally. So the question is, are we seeing that? Okay, so all this information do tell you that the market is going to have a big movement very soon. All right, so with many people are looking to buy because they think it's very good market right now. Earnings is bad, it's okay, but the people who are a little more, in my opinion, more sane, knows that earnings itself is bad. That means that the future earnings will be even worse. So again, two-side view, right? Okay, let's look at this again. The retailer versus the boys. Okay, let's take a look right now. Now, let's look at this date, 16th of August. Now, 16th of August is selected not for the date itself, but it's actually a very interesting pattern here. Now, look at it. From July onwards, the stock market for S&P 500 has been moving up all the way steadily. Right, S&P was 3,900, which is similarly to where we are right now, has moved up all the way up to the high of 4,300. And remember that at the time itself, many people were expecting the S&P 500 to cross to 4,400 because it broke the Fibonacci, everything was good, break the moving averages, okay? Then the thing is this, the volume was actually coming down. So with all this information itself, right, I was kind of concerned. Say that if the market was going up, why the volume was actually coming down? So that was my first concern. My second concern was the RSI was actually at the high level. And if you compare to the previous high was back in November 2021, that was where the market was near the peak. So all I can say is this, guys, that was a very interesting period. But when I actually check on something else, this is a stunner. Watch this. Apparently, this is where the retail trading estimates, the volume itself was actually at the highest level for the last one whole year. Interesting. So that means that when the market was pushing up itself, right, the retailers was coming into the market. The retailers, yes. The retailers was coming into the market, but with the volume going down itself, right, it seems to be a bear trap. And a bull trap, sorry. And truth be told, the market really came down. Okay, so now we will cross back to now where we are. We are almost there, the same thing, but we have the volume going up. Okay, so now what happened? If the volume is going up right now, while the price is going up, is it because the boys are coming in and the retail coming in, so two sides of guys are all going in at the same time? This is going to be a big bull market. So that is where the question mark is all, right? Though I do have my reservation here, and all I can say is this, right? If let's say they are right, the market will definitely shoot up all the way to 4,200. But if they are both wrong, oh my god, the selling will definitely breaks to 3,800. So what do you think, guys? Leave a comment and let me know what do you think. All right, this is going to be very interesting, intriguing. All right, and of course, you look at it right now. Look at this. Let me clear my screen a bit messy for you guys. Hold on a minute. This is the CTAs. All right, their positioning. Now that's about 1 week ago. They are still pretty short in the S&P, the Nasdaq. All right, pretty short, but they have covered back a fair bit position. The only thing that they are heavily short is still on the bond market. All right, so the thing is this: why are they are doing short on the bond? Because they expect the equity market to be good. So this is something that I want to tell you, that means that a lot of CTA guys are also bullish, and that's the reason why the funds are coming in and the market is going up. So if everybody is buying, retailers, the boys, the CTAs are all buying, why would Morgan Stanley be calling for sell? Unless they are put there for purpose, for what? To bluff people? So I can only say this, guys, someone has to be right. And if everybody is buying, the question is, who the hell is selling? So this is the thing that I want to tell you now. The worst economic sign since 1932. Now look at this. This is the real disposable personal income. That means that people basically has no much money left. Okay, if there's going to be any financial crisis, it will hit recession pretty soon. Now take a look here yourself. The last time we have the numbers going down to zero, that was back in 2007 and 8, whereby we have a recession. Okay, now the nearest in context itself was back in 1974, which is where Jerome Powell was there. I'm sorry, my bad. It was because of the Paul Volcker was there and inflation was shooting to the sky. People run out of money and we have that recession, okay? But the problem is this, guys, we are now much lower than you have before. So if the thing is this, if this is not going to be crazy enough, take a look right now. It has stretched all the way here since we're at 1932. Okay, man, guys. Seriously, the market is too vulnerable, it's not ready for any crisis, and that's why probably Federal Reserve likelihood will have to pull the handbrake a little bit. So it might give the market a little bit of rally, but if the market thinks about it for a moment and they know that something is very wrong, things can get very bad, okay? So the thing is that now the combination of people being laid off by companies, we have the home prices coming down right now, and of course people may not be able to pay their bank loans. This is a ultimate cocktail of a potential big problem. So what we have right now is we have a huge big problem on the side, but the boys are buying, and it's a repertoire of what happened in 08-09. Because when 08 was climbing, we all know that the numbers are pretty bad. People are getting their jobs being laid off, and we know that the inflation is shooting up and people cannot pay, but the stock market kept on going higher. So all these are just repeating again and again. And if I'm not wrong, Jim Cramer back then was pretty bullish. Alright guys, so all this information is for you to digest. Let's look at the chart right now to see what do we have. Okay. So first of all, on my KFC chart again, we can see that I expected the market to come back down to here, but the market did come down last night, but a strong rally changed the whole thing once again. But the resistance is still there at 34,050, so we're going to wait for a while. For the Nasdaq, we can see that it misses my technical level and rebounded. Okay, fair enough. And look at the gold market. Yesterday, gold came down to my level here at 1904. Spot on, alright? Spot on. Congratulations for those who have profited from there. And now it's still maintaining above the 1921 level, which I tell you guys, very strong technical support. And the market just really knows that. So guys, this is something that you must collect from me as long as you're a TWB student. And once you go through the premier class, you can get this KFC at the PTP level. Alright? So this is very important information. And for Hang Seng itself, right? It has pushed up, pushed back, all the gaps have been covered. Congratulations for those who followed me. And now let's see what we have for the market. Okay, let's go. Okay, so let's look at the Dow Jones for today. Now, I do expect the market to be sideways because usually when there's FOMC meeting, the market will get very lackluster because no one will take the bet, right? Although we all know that the chance of a 25 basis points is almost confirmed. But again, I would like to stress this point. My KSI is not showing me buying signal. So although it's lowering, but it's still red. So despite the strong recovery and created a new BNB, the first target upside is 34,679. The downside itself is 32,956. So watch out for this, guys. The market has to break 34,100 to go higher, which is going to go to 34,295 first. Now the downside itself today, take note, the pivot one is trading at 33,762. So by default, as long as the market stays above OP, it's a buying situation. But now the thing is this, the price is now trading slightly below OP. So watch out the MLP. That will be the first base. Yep. Okay, now KSI and my KRW both are red. That's why you see the red arrow is there. So this tells you that the selling pressure is actually in the market. Now for the Nasdaq, interesting. We have a very flipping momentum. Buy, sell, buy, sell. So KSI were green, KRW were cyan. So that's why the buying interest is still there, and that's why the market recovered. Now look here. This is the KCB at 11,814, and the market really stopped there and reversed bias. So again, all these technical levels are all created and are being automated by the system, so you just have to follow through. Okay, today the pivot one is 12,057 and the market now is fidgeting around here. As long as the market stays above OP, it is possible for the market to trade higher and is looking at maybe 12,250. Alright, now KSI is green and KRW is cyan, so the buying interest is actually still there. Interesting. Now, S&P 500 have a very strong pullback yesterday, and then it reversed course. Why? Because the KSI and my KRW both were positive. So that's the reason why yesterday I mentioned to a lot of you, I said that even though I'm a seller, but I just feel that the market may buy from the bottom, and it happened. Okay, anyway, a new BNB is formed, so they need to adjust this by lines once again. Okay, now new version 6.0 is automatically adjusted. Okay, so what happened is this. S&P 500 must stay above 4077 to push it up all the way to either 4123 or 4161. The downside itself, the market must break 4049 first. But look at it. Today, pivot 1 is at 4023. So by default, if the market stays above OP, it will be a buy. So traders, watch out for that. KSI and KRW both are positive. So that means that the buying is still available. So you can understand why Jim Cramer is calling for buy, because it is very clear the buyers are still relentless. Now for crude oil, you can see pretty clear that yesterday crude oil plunged all the way to 76.39. I was waiting at 75.40, didn't get hit, never mind. But KSI is great. So the boys are selling, but the KRW is science, so it'll be a mixed bag right now. Now today it's trading at above the BNB SL level, and that is 78.84. So if the market stays up, it can still go back to 82 level. But take note, I've been saying this before. Usually when the crude oil price coming down, Dow Jones index itself is going to come down. So let's just watch this very closely. But because again today it's trading above the pivot 1 by default, as long as market stays above OP, it's a buy. So interesting. All right, so we watch this closely and we see what the Federal Reserve had to say. But usually FOMC doesn't really affect the crude oil much. Yeah. Now for the Nikkei, we can see right now it's trading down. Okay, likelihood is because the yen is pushing up. Now take note here, the dollar yen is coming down because the market is expecting a slowdown in rate hiking, hence therefore the yen increase in strength, and it's not going to be favorable for Nikkei. Now today's a DD means that the OP is a key. As long as the market stays below OP, it's a selling day, and now it's trading below the pivot 1, 27.368, so it will be still a sell. First support 27.253 MA 200. Now both KSI and KRW are both positive, so we do suspect the support will come in around this area here. All right. Okay, so we have the indices all done, and the crude oil. Let's look at something different, which is the forex market. Now the forex market, now look at the dollar yen. Okay, dollar yen has been fidgeting around here, but yesterday we have a new BNB. So 130.60 and 129.20 will be the range for now. But you can see the KSI retain rate, while KRW is blue, a cyan, so that means again it's going to be a mix. Now the thing is this, imagine suddenly if there's something goes wrong on this, if Jerome Powell decided to do a 50 basis point, this will punch the dollar yen higher to 131. But of course, if he say 25 basis point and maybe no more hiking, then 127 will be next. Okay, so traders, you need to watch out for that. For the euro now, we can see that it's also playing around at the BNB support level, and you can see very structurally the market just maintained at 108.50. So same thing again, if the Federal Reserve say 25 basis point and that's it, or lesser, then of course the euro will be going back all the way to 109 level. Right, if not itself, right, it will have to maintain at this point here at 108.50. And last but not least will be the pound. Pound has came off a bit. It's trading below the BNB support level. I feel that pound itself, because UK economy is really not doing that well with the inflation going on, the GDP not doing good. I think that there's a chance to see the pound coming down to 122.68 area. Okay, I believe that. But at the moment, the market is still holding up because the KSI is still green. I mean, the boys are still buying. Okay. All right, then with all this, let's look at the gold market. Now, of course, for the gold market, you can see, let me just bring in the gold. Okay, there's some error here. Don't worry about that. Okay, there we have it. Okay, so the gold KCX is still blank, so that means it's very bullish right now. So that's why yesterday gold punched down all the way to 1904, which is the MA30, which coincide with my KCB at 1904. So this was the there was a 2 stack here, and the market just punched it and recover all the way back itself. That's why we call for buyback at this point. Okay, anyway, for today, as long as the market stays above the BNB support level at 1918, there's no much difficulty to expect gold to go higher. Now, of course, if the Federal Reserve says it's going to be 25 basis point and no more hiking or lesser hiking, that means that the gold can go back all the way to 1950 level. Now, for me, I'm not that comfortable to call for buy right now. I prefer to buy at 1888. So you make your own choice here. Okay, I guess it's just going to go slow today. And for the silver market, we can see that yesterday, because of the selling of gold, it did came down all the way to 22.96. But of course, you're waiting at 22.74. So it's a sideways movement. Now, this is a very pretty big range for silver. So I think that we will be just playing around for a moment and not going to give a call on this right now. And of course, Bitcoin, because of the strong recovery, Bitcoin recovered back to above 23,000. And the thing is now it's touching 23,152, which is the pivot one. So if the market stays above OP and above 23,152, we can see it going back all the way to 23,700 series. But of course, if the market breaks below 22,400 level, we can see coming back to 21,930. But I still look at 20,891. All right. So that will be all for today. Take note of the FOMC meeting, which is coming out later. So go slow, take care, and have a great day. This is Kel signing off. Bye-bye.